You're on mute.
Sorry. Thank you so much. Welcome back, all of you. That was like so. Okay, let's just welcome all of you. I mean, I was in mute and talking to myself unless until Karthik just said I was in mute. That happens when you're on online webinars. So welcome back, all of you, Karthik, Tushar, and Dr. Morain, to another episode of VCTV. We're going to talk about family office investments, how family office are helping startups, in that space, and difference between family office and venture building as well, because it's very important to understand the differences, right? And the deal flows as well, how each of them are different. Okay, just to introduce myself, my name is Sunny Mohanty. I'm the regional director of La Token based in Singapore. I moderate VCTV sessions. And yes, welcome all of you again. Let's have a quick round of introduction. I like to start with Karthik.
Thank you so much. This is my episode number 162 with all of you, and absolute pleasure to be on the show once again. I represent a couple of family offices based out of UK, a venture fund based out of Middle East, and I also serve as a chief operating officer for a large retail business. We primarily invest in edutech, health tech, and fintech spaces, a little bit in government to government funding, and very active in Middle East, very active in subcontinent, a little tight on our deal processes and deal flow management. But that's the way our family office operates. So yeah, happy to be on the show.
Thank you, Karthik. Dr. Morain.
Hello to everybody. I didn't count my number of participations, so hello to everybody. My name is Marin. I had a great career in aviation and automotive electronics, and now have a lot more time to follow my passion, helping entrepreneurs build their ventures. I'm the CEO of Schweitzer World Group. We are a family office and Schweitzer's venture engine and venture capital arm here in Singapore. Our company is a sixth generation business. We did two IPOs ourselves, one in Germany, one in Singapore, and feel free to call me a dinosaur. Besides my executive role, I'm sitting on a couple of advisory boards, including one big insurance company, HDI Global, in Germany. Happy to be here and share my view on how we, as family offices, are doing our investments, how we engage with entrepreneurs, and the secrets you should know when you reach out to family offices.
Sure. Thank you and welcome back. Tushar, welcome back. Long time.
Thank you, Sunny. It's a pleasure to be discussing this topic with Karthik and Dr. Marian and yourself. I'm Tushar Kansal from Consultancy Ventures. In my previous life, I've worked for Big Four Consulting at Deloitte and Touche. Also been part of Brand Capital, which is venture arm of the Times of India Group, and headed treasury with the Russian telecom company Sistema's India unit, raised almost $2.5 billion for the company, and was CFO with the company owned by Guggenheim Partners, the American PE fund. I am a mentor and judge at entrepreneurship cells of top five educational institutions in India: the IIT Delhi, IIT Mumbai, IIT Chennai, IIT Kharagpur, and IIT Dhanbad. We are also a venture advisor with Loyal VC, which is an INSEAD-led Canadian VC fund, having a core portfolio of over 160 investments in more than 35 countries. Uh, and keep on appearing for La Token VCTV. Love discussing various topics and happy to be here today discussing family offices as well today. Thank you. Thank you, Sunny.
Thank you, Tushar, Karthik, Dr. Morain, and welcome again. So, as Dr. Morain was saying, the secret sauce to reach out to family offices. Why do we need a secret sauce to reach out to family offices? What's the difference between family offices and venture builders? Let's just start with Dr. Morain herself.
Oh, that's a very good question. So, at a larger sense, family offices have a very wide scope. They are not all the same, but it's very wide. So, if you think of a venture capital fund, they have a clear focus on raising money for their fund and then distributing it to a certain number of startups in set stages, while family offices look at a larger, wider portfolio. So venture capital is very often only one asset class, so they can also take higher risks. They are looking at most of them are looking at earlier stage investments. Furthermore, too, is what we've seen, and not only our family office, we appreciate a lot entrepreneurs. So we like people who identify problems and offer solutions to the market to solve these problems. So it's pretty much like our own business history. So we are all entrepreneurs and didn't just buy into capital. And three, we like to be mentors. We like to be advisors to our startups. And many family offices, they're very happy to do so. And they engage deeply with you as startups and help you de-risk your journey to become successful.
Great. Thank you. Thank you. Thank you, Dr. Marin. I think nicely explained. So yeah, same question, Kartik. I mean, obviously you've worked with VCs. You also represent family offices. So what's the biggest, I would say, what's the main difference you would say?
The nature of business and the objective of the beast is very different. VCs is all about trying to take risks, bet, primarily because the dollar belongs to somebody else and the dollar gets invested somewhere else. So I would say that their ability to take risks, the risk appetite, and the return judgment that they bring to the table is very different. They would spread their dollars across all spectrums, right from your angel funding going all the way up to a Series B, Series C. They have certain caps in terms of investment appetite and investment abilities. But a family office, on the other hand, primarily works with an idea of bringing scale and building reach and taking a product into the market. So, apart from bringing dollars onto the table, VC offices, primarily more often than not, would always be looking at the dynamics of growing, cultivating, and selling the business and cashing it out. While a family office necessarily works at building scale, owning, and then expanding the business downstream in a manner that it continues to sweat the asset all the way through the life of the asset. Sales, more often than not, is not the primary criteria, or a multiplier is not a primary criteria. Even the way to evaluate the returns from the business is very different. I often meet VC partners who would give me a commitment of 3x multiplier, 4x multiplier, while for me, as a family office business, anything that gives me a 15, 16% annualized returns is more than I'm more than happy with it. Anything more than 18% actually scares me, because that's not the way dollar operates across the world. Also, from a perspective in terms of the ability to offer beyond dollars, family office, if they're not a very VC funds, if they're not a very strong incubator, often suffer the entire bandwidth challenge. While a family office not only brings the advantage of an inbuilt incubator, but more often also brings in advantage of downstream market. So let's say if I support a startup in cyber technology or cyber security somewhere else, I would also have downstream integration with my banking partners and my security partners and my e-commerce companies in my portfolio, where I can buy those services, integrate, sell, and make the entire ecosystem work. And most large, the kind of family office that I work with works primarily on a government to government approach. So getting and democratizing something at the bottom of the pyramid and raising scale and making something feasible in a larger geography is much easier done with a family office than would be with a VC fund, because VC fund would still necessarily have to comply with all the regulatory compliances and would not be often found trading off with the government on regulatory norms. So that there's always a plus and the minus. Getting a VC fund to fund you would be significantly easier and faster compared to a family office, because a family office, while a VC fund would be happy to do a 1:8, 1:9 success story, I would lose my family office trust if I were to go any less than 1:2. So if a venture fails out of two ventures, then that's the end of the road for me at the family office. That's how it works. So that's the key differentiation, or the key differential between the two elements.
Great, great. I think yes, yes, absolutely rightly said. And these are big differences, actually. Thank you, Kartik. Tushar.
Yeah, so have been fortunate to have worked with some family offices in the past, and especially recently with one family office which is operated by a family with more than 70 years of lineage in the business. So my view of family offices is that they like to play on their strengths, and their strengths more often than not is understanding the complete cycle of a business right from the start to setting up the processes and forming teams, and their understanding of the sector also. So they always feel, whenever I speak to a family office person, they always feel that they are coming in with a lot of institutional strengths and institutional memory of how to do things right. But that also means that in some ways they restrict themselves with by staying away from investments in those areas where they have typically not understood how the sector works. This is very true of technology, where lot of steps have been taken by a lot of family offices to invest a little bit of money initially, study the journey of firms in these sectors, forming a thesis, an investment thesis around those sectors, and also understanding from a market perspective, as in with the technology sector of a particular country is at which point. And so the checks they have been writing for technology startups have typically been smaller as compared to the
Yeah.
checks written by VCs.
Yeah. All right. I think that's very good to know, understand the differences, key differences, as Karthik rightly said. Coming to startups investments, obviously the ticket sizes, Tushar said, is lesser. But how would you explain the deal flows and the relationship with the startups when a VC is involved versus a family office is involved? How does the deal flow happens? How does it vary? What are the differences? And what are the challenges or between the two that the startups do face?
Well, deal. Should I start?
Go ahead, go ahead.
Yeah, sorry. So I think with the current craze of the valuations which are floating around, people see stock markets and the multiples which are doing the rounds. I don't think that there would be any lack of deal flow with family offices, because a lot of people approach these investments based on relationships, and to my mind, but it does create a FOMO factor with the family office, the fear of missing out. And it's a fear of not jumping on the bandwagon, like Reliance, the Mukesh Ambani family, they created Geo, and then they attracted $44 billion worth of investments. But prior to getting those $44 billion from Google, Facebook, Qualcomm, and so on, they created a whole investment ecosystem around new age technology companies by either buying out those companies or investing in them. So so the deal flow was always there. They took baby steps initially, then they did M&As, and then they were able to attract almost $44 billion worth of investments. Sunny?
Yeah, 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 yeah. Oh, yeah, I was listening. Thank you so much. Karthik, over to you.
So the deal flow, the logic of the deal flow is very different. A typical venture fund would have a deal sourcing team that primarily continues to look for deals across a sector, across a dimension, and have very specified roles in a venture fund. For example, somebody would call themselves an early stage fund. Somebody would say that I'm only a Series B and a Series C fund. Somebody would say I'm an incubator fund. A family office looks at it in terms of what is the pie that they have in a business. So are we tomorrow, if the board decides or the trust decides that our growth is going to come in from e-com, then the drive is towards e-com, and then it balances out. For every half or one investment into a startup, do I acquire a large established entity? Do I buy geographical rights for another entity? Can I invest dollars into a company and take its sourcing rights, or can I take its last mile delivery? If I've got somebody's last mile delivery, how do I make sure that all my portfolio companies benefit out of it? So it doesn't invest. A deal flow doesn't necessarily happen basis a deal in the market. It happens basis the demand for it in the family office. So what are the voids? What are the blank spots that I have? If I have a blank spot in my QSR business, if I have a blank spot for a central kitchen, then I would invest in a central kitchen startup, and I would keep looking that out of the 10 startups in this space, which one is the most promising startup, because my requirement is to provide a central kitchen to my online food businesses and my online delivery partners. So it's a very different logic, because my end game is not to sell. My end game is to make my business successful. Or if I have a government to government, like say for example, if I'm discussing with a government of one of the East African nations, and their requirement or a trade-off is that I'll give you farming land, in return I'll give you 18% duty buyback, you have to make sure that I have food security. I'll bring in a food security partner on the table and I'll invest dollars there. So it's about, in my larger space of business, what are the voids that I will fill? And that's exactly how deal flows happen. In a VC business, deal flow would sometimes happen. And then I don't understand the VC business that much, so I might not be qualified enough to say that, but it happens a little faster. In a family office business, there are times when startups and businesses get bored of the pace at which we work, but then that's the way it is, because I will need to make sure that, for example, I'm trying to incubate a business or buy a business in US. I need to make sure that the legal lawsuit problems that it has doesn't bring in disrepute to my banking business in some other part of the world, or my new license that I'm going to acquire in US for another business. So it's a cobweb of business where, while a VC deal flow is purely about dollar in the bank, a family business deal flow is also about a lot of reputation and respect that the family has. Certain families wouldn't even want to put their name. One of the families that I work is completely against the idea of me talking about any deal in tobacco and meat or tobacco and alcohol. I had to let go a lot of tobacco and alcohol deals only because of the virtue of a family business. So the deal flow is very different, and even the deal due diligence is very different. Not all due diligences are done basis what is the present value, or what, how good or how promising the startup is. Deal flow sometimes is done as a trade-off, that if we set this company, we trade this off in some another geography, what is it that we'll get out of it in the deal? So that's how deal flows work.
Wow, that's good differences. I mean, these are big differences as well. So, Dr. Marian, over to you as well. I mean, obviously you are a family office yourself. Do you also work with VCs in collaboration, sort of co-investing into deal flows? And what's the difference have you seen? If yes.
Well, with very valuable insights from the previous comments on your question. Let me share one more thought. We have a double strategy. So one is we are acting like a VC with pure financial KPIs in specific domains. These domains are further away from the core business. And then we have our second stream, and that's what Karthik just shared. It's a very different animal. We have our own ideas. We identify white spots, potential new adopted value propositions for our existing own businesses, and then we initiate a venture building process. And this one works differently than a normal VC deal flow. I can come to that a little later in our talk. What was your question again, Sunny?
Yeah. So, how does the deal flow vary between a family office and a VC?
Yeah, first of all, family offices are reluctant to pay management fees while becoming LPs in Fund A, B, C, D, E, F, G. That's the easy one. If you start in a new market or in a new domain, you might want to opt for one to start to understand and run through a learning curve. Learning has its cost. But if not, family offices, and I'm speaking for myself, and potentially other family offices will agree, and not out there when they're watching us, is we prefer to do syndicate deals alongside other family offices, alongside fund managers, GPs. That's a very wide aspect, but it's syndicate deals. And if you're already convinced and did some research study, background checks, potentially understand the domain very well because it's close to your core business, then you might want to invite other family offices to join in a syndicate deal or a co-investment vehicle. The advantage for entrepreneurs and founders is that uh, there is that syndicate that groups interest, and you only have one interface to talk to. So if in the syndicate, let's say there are 10 family offices joining forces, you only need to talk to one interface while doing your business for reporting. So it's also easing the process. So that's what actually real life looks like.
Yeah, sorry, I just want to one question. So you don't family. If I heard it correctly, family offices do not pay management fees. Is it when they are an LP or they are a GP? So just want to.
No. If you join as an LP, you pay your management fee and your carriage. But as family offices, very often there is not that big value of becoming an LP in a fund. That's what we believe in.
Sorry,
So
Karthik, you were
I'll
saying
add,
something.
I'll add to what Marine said. It's like putting two carts behind a horse is trying to make a family office an LP, because a family office itself is an LP. The trustee of the family office is an LP. He is the man sitting with billions of dollars. Now, if he chooses to become an LP in somebody else's business, then you're trying to put two carts before a horse. The horse is going to be over leveraged. A family office typically comes in with skills to manage its funds. That's what they've been doing, and that's what they've been making money. It comes with skills to take risk in its particular manner. It has portfolio management abilities. It has incubation abilities. So rather than making a family office a LP behind you, you would rather bring them on board as a co-investor sharing risk, because by the virtue of their size, they would be able to dilute the risk for you, and they would be able to offer you scale as your startups grow. So let's say if you were a startup, I mean a venture fund, and I was a family office, instead of making me an LP with you, you would be better served by bringing me as a co-investor or a co-securitizer with you. Your job is to take a startup from zero to Series A or Angel. Once you see the proof of concept coming in, you bring a family office with that can grow, scale, and democratize it to put more dollars. You continue to stay invested in the deal, and you let the family office bring scale. So both of you are able to give justice to the business. You're not leveraging the family office skills. You're only leveraging the dollar by making him an LP. But when you let him play alongside with you, you are leveraging his skills to take you downstream, take you global, integrate the businesses, and market the business. The most important part of a startup today is not about just giving dollars. It's about commercializing the startup, and that's where a lot of people fail. Family office, by the virtue of running 10, 15 businesses, Marine's family office would be running so many businesses. Using a family office to democratize the business is a far better game than using the dollar. It's like me trying to, run a Formula One car as a taxi. You wouldn't want to run a Formula One car as a taxi. You would want to run a Formula One car to win a race.
Right. So, Dr. Maran, you want to add something to this?
Yeah, that's a lot about the unfair advantage we are having as family offices and corporates if we have operational businesses in our back. You know, there's no real value just to chip in the money as an LP in many cases, but there's a lot of value if we invest alongside and then offer and share the unfair advantage. If you look at the statistics, 1 in 500 startups uh, succeed in the wild, while 1 of 8 succeed if there's a family corporate backing up the journey, which is basically de-risking also for the LPs of the fund that have invested alongside. So it's a win-win situation.
Right, got it. Thank you. I just want to know when it comes to the startup ecosystem, you have various pieces involved in that ecosystem. So, what value does a family office brings to that ecosystem in comparison to a VC? If there are any differences, Karthik.
So look at it this way, and this is an example that I give in a lot of my discussions as well. A VC is a coach to an orphan child who coaches him and who can give him food, shelter, and coach him. But a family office is a foster home and a foster family. It not only feeds the child, it owns the child up and then gives the child the wings to fly. And that's the difference between, until unless a VC is an incubator VC, which comes in with the bells and whistles of commercializing the business, you would often find yourselves behind the eighth ball in terms of answering questions about where did the money get invested. The moment you become a part of a family office, obviously the role that a family office will play is significantly large. There are chances, if you are a smaller startup with very limited hedging abilities, you might lose yourself. But then the benefit that comes in is that you have an umbrella that allows you to grow, make mistakes, take risks, and even if you fail, there's somebody who's watching you every day to make sure that the business doesn't fail, because his interest is not in your idea. His interest is in making sure that your idea brings money back. So there are no hire and fire in a family office. There is no selling of stake that I invested dollars in you as a VC and you didn't work, so I'll sell my stake to somebody else and somebody else will merge with you. It doesn't work that way. I'll take a lot of time to invest in you, but when I've invested in you, I'm going to make sure that I spend enough time to make you successful, because my success lies in your success. So
There are no
that's
exit strategies, no exit
there,
strategy.
there's no, I mean, at least we don't follow an exit strategy. Both the family offices that I work with, they don't follow absolutely zero exit strategies. The idea is, how do we make this business work? If he has an idea, let's give him infrastructure. If he has infrastructure, let's give him a market. If he has a market, let's bring him the customer. If he has the customer, let's make sure that I augment more products and I use that. So whatever part of that ecosystem the guy brings in, we bring the other parts of the ecosystem, because at the end, when he is successful is when my valuation for the business, my enterprise value, the difference between a VC and a family office is, one looks at a multiplier. A family office looks at an enterprise net value. What is my enterprise net value? How quickly can I go to the IPO stage? How quickly can I take this product out globally? How quickly can I make sure that this product, this my two enterprises merge and I unlock more value out of it? So there is always a growth, which is why of late, if you notice, the number of people and number of businesses that are trying to reach out to family office is more. The only challenge is that because we are so risk averse, I wouldn't say we are risk averse, but we are a little bit pragmatic on our approach. The deal conversions are limited, but the deal failures are not. There are very few deal failures.
Right. Got it. Thank you, Karthik. Tushar?
Yeah. Yeah, I mean, I would, I think what it makes sense. A lot of what Dr. Marin and Karthik said. So the example is there. I mean, we saw that just like we have been seeing this phenomena take shape of old conglomerates buying up companies, especially more than 50% equity. So in a way to have control over the things there, and then helping not only on the balance sheet side by the investment, but also on the profit and loss side. And so if you are able to get them a lot of business, that also aids the cash flow, and in return the value of the company goes up. And we have seen that these family offices, they have good teams, and many of the time they have fund managers who have already operated companies, have made investments and handheld companies. And see, to my mind, apart from the business side benefits which come from a family office, there is also a know-how of the market. And these family offices, since they have been operating in certain markets, so for example, Times Internet is the investment arm of the Bennett Coleman Group, which operates Economic Times and Times of India. They have taken more than 50% stake in other companies which are into multimedia and media. And because they understood the market a lot, they were able to grow these companies and enjoy the benefits of enhanced valuation. But having said that, I think the cost of capital for a family office is also different from the cost of capital which a typical VC faces. A VC would need to give a return of 20 to 30% IRR based return, whereas a family office can have an entirely different cost of capital owing to the sector in which it operates. and that can also mean that the patience of the family office towards investing in businesses for maybe 5 years or beyond that is more as compared to VCs, because VCs would need to get exits and give the checks back along with the return.
Yeah,
So
that's what.
yeah,
Sorry. Go on,
no,
go on.
please.
Sorry.
Okay,
IRR
so
is a function of risk. Yeah.
So
yeah,
that's
yeah,
exactly
true.
what we do. And I completely concur with what Tushar is saying. A VC fund needs to give a 20, 25%, 30% return back to an LP. And still, if I were an LP, I would not be happy, trust me, with that kind of return. It's because the risk matrix that I'm exposed to is significantly higher. There would be years where my entire dollar would be bottomed out and the cash flow of a VC would be jeopardized, and hence its ability to generate returns is going to be minimized. And hence there would be years where returns would go up to 70, 80, 100%. There would be years where I would have to pump in more dollars to salvage the VC fund out of its boots. Considering that 1 is to 6, 1 is to 7, 1 is to 10 risk matrices that they work in, a VC fund needs to justify that. For a family office, there is no concept of wealth depletion. If I'm a family office, if I'm a family office arm, or if I'm a family office investor arm, if I deplete wealth, nobody would touch me with a 5 meter pole. I'm not authorized or not allowed to deplete wealth, which is why even if I give a 12%, 4% plus I LIBOR, 4% plus LIBOR it returns to the business, I've still done a fairly good job because the dollar is intact. All I've done is stacked up more dollars on top of it. So because there's no dollar depletion, the final IRR is always going to be more or less the same in both the cases. It's at the end, there is no way in the world that money grows more than 14%, 15%. If you start getting 30, 35% money, it means somewhere along the line either you are exposed to more risk, or somebody in the value chain is losing so much dollar that when the circle turns around, you would start depleting your dollars. Money grows only at 14% across the world. So I wouldn't expect more than that to come into my plate.
Right. Sorry. Tushar, did you want to add something to just what Karthik said, or?
Yeah, that's very true. I mean, so typically what I have seen some family offices do is, uh, you know, uh, some families, what they do is they incubate entirely new businesses by taking debt on the balance sheet of their original business. And once this debt plays out, the companies get created, a lot of value gets created, then they go in for unlocking that value at a very huge kind of valuations, and then they deleverage the balance sheet. So I won't recommend this strategy for a lot of companies, because it entails substantial amount of leverage. It entails a lot of risk on the parent company's balance sheet. But again, I've seen that a lot of companies have gone this way because especially those companies which had access to international debt, which comes with 0.5% kind of interest, or 1%, or even if you add hedging, then it adds maybe a total of 4 to 5%. But having said that, there are conglomerates and companies which are operating across boundaries. So what happens is that they don't need to take hedging, because by the usual course of business, their 50% exposure is in dollars and 50% is in non-dollars. So because it is that way, they don't need to spend the 4 to 5% on hedging, which means that they are utilizing 0.5 to 1% interest rate debt to create substantial value in new age companies, and then unlocking that value at billions of dollars of valuation. And so that is what Karthik, I fully agree with what Karthik said about the difference in the cost of capital structure for family offices and venture capital funds.
Awesome. Thank you so much. Next, we move to Dr. Moraine.
I think family offices are like parents, and the startups are somehow the corporate children. You are a toddler, then you grow up, then you become a teenager. You might have difficult times in that relationship, but the parents are there to stick with you. There is no time pressure. They want you to succeed. They want you to grow up, and Like in private life, uh, if you have kids, they might choose a different path at a later stage, or pivot to something else they really like, where their passion is. And you can imagine the same for the corporate world from family offices, and that's our perception. If the startup sees, okay, that's been the value proposition, we've learned something now, we'd rather go there and follow it with our passion and have a vision and also a value proposition in the market. Families offices, they will help you, guide you. And for the multi-generational family offices, I would also say you'll find grandparents who are different, where you can talk to, get a guidance. And furthermore, many family offices, and we have a large talent pool of a very diversified team that can help you on specific topics. Expert knowledge, open you the doors, guide you and help you as a sparing partner to make you thrive. Secondly, you can tap on shared services. Let it be get the financing done, get the controlling done, get the banking relationships done. That's the fast path lane via shared services. Make your life easy as an entrepreneur and focus on building your venture and not on the admin tasks. The family office and the corporate, and that's different to many VCs, they have that backbone. So they can chip it in and share it with you, and you might get the better deals or somebody in the family office who does that for you in a professional way, while also understanding your needs as a grown up or as a toddler. And lastly, it's about the network. It's all about network, and that's what ecosystem is actually. And family offices, they have their leadership who is focusing on connecting people. They like it and they love it, and they do it every day. I'll open you that door, and we are having a lot of connections between our portfolio companies. Actually, they're helping each other, and that's what a real ecosystem is about. And sometimes it works, sometimes it doesn't, but that's not so important because we look at all in the long run. We are thinking generations. We made it until the sixth generation with our company, so we are proud about this because only 1% of companies grow older than 100 years. So now our next challenge is to make it to the 200. And we are very happy to have a lot of entrepreneurs and startups join our journey. And it's a lot of ingredients, like cooking. There's no one simple answer, but there's a big difference.
Great points there, Dr. Marin. And thank you so much for sharing, parenting startups. Okay, talking about parenting, and the family offices prefer, obviously, everybody agrees they do not believe in letting go of their startups. So, how do they evaluate startups, and what's the difference between how a VC would do rather than a family office? So, what's the differences? How do they evaluate startups? Let's start with Karthik.
So we don't evaluate startups. We evaluate what do we need. For example, I specifically today know that these are the only four options or three options that I have in my mind, and then I go out to evaluate and look for startups in that space. So the opportunity doesn't come in with I have money in the bank and I need to grow it by so much, so I will go it. No, that's not how it happens. It happens by the opportunity, and then when I have deals on the table, I look at who has passed the proof of concept stage and who has passed the threshold stage. Necessarily growth or a stage A or a seed funding is not something that at least I get into, because it sucks up a lot of time and there is absolutely no return in terms of scale. However, if you've crossed a particular threshold, if you've matured your business, if you've been handheld by a few people, groomed well, then you are the choice that I would make, and I would I would invest into you and take you to the next level. Now then I see is, are you the right partner or are you the right business for me to acquire to be a part of my overall ecosystem? Can you grow into something that would sync well or would integrate well into my overall business? Because if you have the right tentacles or if you have the right wings in the business, I would then be able to create a cobweb of relationships. If you are not a kind of product, or if you're not a kind of startup, or if you're not kind of team that would be a part of my overall large ecosystem, then you do not exist. Because today you might come in as an ABC Enterprises or ABC LLC, but tomorrow you are going to be a part of a large business called the IDF. Now IDF would have 200 to 300 different entities, 30 to 40 CEOs, are you a kind that would become a fabric of the business? Are you able to join and coexist with others? Because there is no space for any one individual. Even me, I don't exist as an individual, I exist as a part of an ecosystem. So can you be a part of my ecosystem? Can you allow and help others to grow mutually and cohesively with you? Because that's how value creation is going to happen in my business. You might have the smartest idea, but then you cannot run a relay on your own, and you are getting into a relay with us. So that's how we evaluate startups. Obviously, the commercial evaluation of startup is purely in terms of downstream integration. What is the value that I unlock? What are the various asset classes, or what are the various commercial elements of that business that I can sell off? For example, if I were to take a technology company, and if I were to invest in a technology business, let's say cybersecurity business, I would see that, okay, I have investments in banking, I have investments in e-commerce, I have investments in aircraft businesses, I have investments in aviation and transport businesses. Can this cybersecurity, to what element can I peel off the cybersecurity and plug it into each one of them, sell the rights to those companies there, make money from them as a licensed product, make money for this as a revenue, and how do I fund this at a working capital level and draw my 18-19% over and above the returns that I get on them, is how I see this. What is the level of commercialization? It's typically the way an Indian entrepreneur looks at sugarcane. First you draw the juice out of the sugarcane, then you draw the shred out of the sugarcane, and then you burn the damn sugarcane to make money out of it. How much more can I sweat the asset? It's the asset sweat, possible asset sweat, that we look at, and not only the commercial value of it.
Interesting. Thank you so much, Karthik, for sharing that. Tushar?
I think, given by the typical background of family offices coming in from institutional companies, which have been almost institutions in their own right, uh, I would tend to feel that incubating a company to the MVP stage, minimum viable product stage, and then to the PMF stage, product market fit stage, would come naturally. But I don't think that is very true. End of the day, incubating new companies which are fledgling, which needs systems and processes and KPIs to be set up, which need to be provided market access. I know of this venture capitalist who invested in a company, and then continuously for 1.5 years this guy was getting them business almost by giving indemnities to large companies in his own name. So he was, in a way, telling big companies, you give business to this startup and I will indemnify you of any losses. And apart from that, he was also making them understand the best practices which are followed by similar kind of companies internationally, so that they climb up the knowledge ladder pretty fast. So all that kind of hand holding, it does look natural for family office to do that kind of hand holding better. But there is no data available in the public domain to say that that is true. End of the day, it really depends on what kind of people you put on the job, and those people, whether they are following certain institutional processes, and apart from money, what do they bring to the table. And that's why I suspect that a lot of family offices believe in taking larger equity stakes, even to the extent of 60%, between 30 to 60%, because somewhere they want to provide larger benefits to these companies, and see them through right to their maturity, and not be thinking that they only have minority stakes in these companies. So I think they are more comfortable with larger stakes and going all out to create substantial value for the shareholders and for their own self as a shareholder.
Oh, that's a lot of stake, right?
Yeah.
So, I mean, Karthik, you also work with so obviously the family offices that you represent, they also put that stake into in a negotiation when you're negotiating?
So it's we deal differently. We don't negotiate purely on the stake. We sometimes get into a multi-layered deal. For example, if I'm funding you, I'll get into an ROI deal or ROS deal on the front, and I would get into commercial rights and licenses for the product in certain other geographies with a 5-year buyback rights or a 5-year conversion into stake. So that at some point in time, certain businesses do not want to dilute their investments because they want to go into a VC fund at some stage, or they want to hold the stake because they want to commercialize it. And I'm fine with it as long as I have the rights onto the product. See, again, the idea is I don't want your stake. I don't want your valuation. The end idea is we might want your organization. That's why we are spending a lot of time, and we want you to be a part of our organization. So when I want you as a part of my organization, I'm happy to open a lien onto your books. I'm happy to open a credit line onto your books. And the way to securitize the credit line is the end product that you produce, and the rights that you have in different geographies are mine. So I tap the entire value chain front of the value chain, and I commercialize the value chain. So let the organization own in the balance sheet. It works very well for me. I have an open balance sheet with an organization in terms of unsecured funding, or let's say partly secured funding. And at the other end, in my asset sides, I have rights and contracts which are open for different geographies for me, giving me a steady cash flow with very little investment in terms of cost of goods or very little investment in terms of business development. So for me, it works very well both ways. If there is a pure stake that I would want to buy into a geography where I have nothing to do, as a business, we prefer to choose minority stake because we do not want to be seen as businesses which are looking at building stake and valuation. The moment you get into a particular threshold valuation, we would, at least for the first 5 years, till the time we know you, we might not want to build a majority stake because it opens up a lot of risk and it brings the ownership back onto us completely about making you successful, and you would stop making all the efforts. At some point, if you choose to exit the business, I would need to have that much faith in the business to make sure that I want to completely own it. So we
Right.
generally don't go with a majority stake on day one.
Right. Interesting. Uh, Dr. Moraine, coming over to you.
Well, pretty similar thought. We are running in respects to valuation on a 1+3 approach. The one is very much like VCs look at it. We look at the business metrics. It really depends on the stage. If it's an early stage, it's more these metrics. If it's a growth stage, it's more that metrics. And then we look at one of the three additional ones. One is how can we contribute to de-risk the business? Secondly, how can we set up that ecosystem play? Kartik so well explained. And thirdly, how much does our credibility come into play for this investment with our own brand, with our reputation, and so forth? So it's all these angles we look at it, and then it's a tailored approach. It might be a minority, it might be a majority. I have no set answer on it. It also depends actually on the business itself, on the markets, as we have heard, and also on the team for sure, and just the window. It's also important to be at the right time, at the right place.
Perfect. All right. Thank you so much today for sharing your insights about family offices. I think it was a great episode, understanding investments. So I think, Kartik, thank you so much for explaining in details, and same to Shar. So before I wrap up, just want to know, our family office is investing in cryptocurrencies or NFT, and are you also looking to work in that space? And so, yeah, Kartik.
Honest answer, I don't know crypto space. I don't understand crypto space. I hear everybody around me talking about Bitcoin, and I know of a few people who work with me in the advisory space and for different family offices would have made billions by now. But the fact that I don't understand, we don't invest in it. In my personal capacity, I've tried on a couple of occasions, but the portfolio value is very small. Yeah. So I don't understand. While it would be an interesting space for somebody to educate us, the head of the trust the third generation leader of the family office or the owner of the family office himself doesn't believe in making money at a particular pace. So we follow that vision, and we continue to work on that vision. But yes, crypto definitely is a great space to be in, and if there's an opportunity that is de-risked, I would love to look at it. But thank you so much for having me on the show.
Thank you, Karthik. Tushar?
Yeah, I think definitely there would be family offices investing in cryptos, and you can't escape something which has grown on the back of digital, grown on the back of technology, which is can be used across borders, and which has combined market capitalization of $2.5 trillion. It can't happen without the involvement of big dollars, of big families, and banks coming in, jumping in, buying $500 million worth of Bitcoin. I keep on hearing somebody is buying $600 million, and all institutional financial institutions which have been in the market since ages. And this kind of thing has an institutional role, and definitely there would be family offices which would be dabbling in cryptocurrency. So that's what I feel. And thank you so much for this talk today. And you can viewers can reach me out on LinkedIn by my name Tushar Kansal, and on my website consultancy.com, and my email tk@consultancy.com. Thank you, Sunny. Thank you, Karthik, and thank you, Dr. Marin.
Thank you, Tushar. So, Karthik, where can they find you? Where can people find you?
LinkedIn and social media, and on your shows,
All right.
wherever.
Thank you. Thank you. Dr. Moraine, same question. I know you are, you like NFT.
Yeah, I do, but there's a reason for it, and not only because it's a hype. Also, it feels a little bit like a hype, and we as a family offices are careful. And I knew that you wanted to ask that question. So, in respects to crypto, we've been looking at it since 2019 very carefully, because we thought like this is an asset class that one day cannot be ignored anymore. So, but what problem do we want to solve? That's always the question. What's the problem, and how can we solve it? So the conclusion, to keep it short, is we believe you need to look in automated trading to de-risk your crypto exposure. And there are solutions out there we already identified. And in respects to NFT, yeah, that's a Rodeo market, but the same question, what problem do you want to solve? So is this only a crypto kitty play where you want to have affordable pieces of digital art and hope that the value is going north and you can resell it on the secondary market one day and make some money, or even become rich? But that's not our perception. We are looking what problems for artists or for the creative community can we solve with NFTs. And there's a sweet spot. And that's very much linked to the secondary market to make artists, the creative space, participate in resale value. So it's a little bit early stage. So maybe we should talk about NFTs in a couple of weeks. And I have more to share where we want to position ourselves. But we are definitely interested. How do you get hold of me? You can find me on LinkedIn. Certainly go to the webpage, what you see, schweitzer.world. If you are an entrepreneur, head directly to the venture engine section, and you can also pitch on a web form your idea, and we are very happy to come back to you, and would be more than keen on getting into a discussion with all of you and do a deep dive that you get to know us not only on a VCTV show that I like a lot, that we all like a lot, but also in your own journey. So take us as parents, very welcome. Our parenting door is always open for you.
Thank you. Thank you so much, Dr. Moraine, Karthik, and Tushar, for sharing your views today on the show. And yeah, you have a great day, and I'll definitely come and meet you again on another episode of VCTV. Until then, take care. Keep safe. Bye.
Thank
Bye.
you. Thank you, Karthik. Thank you, Dr. Marin.